After a wave of volatility, global stock markets appear to be stabilizing. The question is whether the recent correction was just a dress rehearsal for a market rout yet to come. The recent gyrations began after the U.S. Department of Labor reported that wages increased more than expected in January. The uptick was minor. Average hourly earnings rose to 2.9% year-on-year in January from December's 2.7% annual gain. But it was enough to raise fears of inflation and higher interest rates. Within a week of the data release, the value of shares around the world had dropped by $4 trillion. The most important market, the United States, declined by more than 10% from its record level in January, with the Dow Jones Industrial Average recording 1,000-point-plus declines on 2 separate days. The declines have been even steeper in Japan, China, and Hong Kong. Some argue that this is ultimately a healthy development, as risk returns to a market that had been eerily calm thanks to years of ultra-easy monetary policy. IMF Managing Director Christine Lagarde called it a welcome correction. But there remain serious reasons for concern, from political instability to mounting global debt. In the U.S., investors are no longer viewing President Donald Trump's tax cuts as a boon for capital investment and productivity growth, but rather as a potential source of economic overheating and fiscal strain that will force the Federal Reserve to raise rates faster than expected. So, will the recent correction turn into a bear market? The answer is not yet clear. According to Robert Shiller, who warned of inflated asset valuations just 2 weeks before the Dow went south, the U.S. stock market looks a lot like it did at the peak before all 13 previous price collapses. But as Shiller also points out, it's very difficult to see the bear coming. There have been 10 corrections in the S&P 500 over the last 2 decades, and only 2 led to a bear market. Optimists point out that economic performance appears to be fairly strong in the U.S., not to mention much of the rest of the world. And corporate earnings have been rising. Still, with the global economic recovery being powered by expansionary monetary policy, and the Trump administration risking a fiscal blowout in the U.S., consumer and business confidence could be more fragile than believed. A downturn would quickly expose the depletion of the policy tools needed to counter it, and stock market investors who didn't flee to safety in time could end up being badly mauled.